Fourth, the international gold standard subjects a country to alternating bouts of inflation and deflation. For example, if the U.S. were to run a surplus under the gold standard, gold would flow into the country, it would increase the money supply and drive prices up. The country that was losing gold, that had the deficit, let's say that was Great Britain, would find that its money supply is shrinking because gold is flowing out of the country and therefore its prices are falling. But we have to ask ourselves, why do these deficits and surpluses occur? Are they an act of God? Well, no, of course not. Okay? Let's take the United States. The United States, just as the world was under the gold standard, the United States today is a single currency area using dollars. Do we worry about or even know whether, for example, New Jersey has a deficit or a surplus with California, or whether Nebraska has a deficit or surplus with Indiana? Fortunately, state governments don't keep those kinds of statistics, so no one worries about them. If they did, of course, then we'd have people would be worrying about the balance of payments, from in their town and so on. Okay. The point is this: let's say that there's an increase in output in California. Okay, an increase in productivity because of the high-tech industries in Silicon Valley. Okay, that's a good example, I would say. And on the other hand, there's a fall in output or a fall in the demand for output from Michigan because U.S. cars are no longer in demand. Well, Michigan's exports, the things that they sell to the rest of the country, would begin to decline. On the other hand, California's exports to the rest of the country, the computers and software they sell to the rest, would increase. Okay. Michigan's citizens and so on would find that they had fewer dollars as their incomes fell. California citizens, on the other hand, would find they had more dollars. So money would be redistributed from Michigan to California. But that's not deflation. Or deflation in Michigan, inflation in California. That's simply a result of the fact that the demand for output in a certain area has fallen, and therefore people's incomes in that area have fallen, and people want to hold less money when their incomes are less, so that the money supply falls. It's a voluntary action on the part of the people of Michigan who are losing income. Okay, think about it. If your income was cut in half, hopefully that doesn't happen to you, but if it's cut in half, you're not going to hold as much cash anymore. Okay, so cash is going to flow out from your household for a while until you have the proper reduced amount that maximizes your utility. Your household's going to have a deficit. Okay, if you lose your job or if you take a pay cut. On the other hand, if your household enjoys an increase in income, then because of the higher value of your labor that you're selling, you're going to find that money's going to flow in. You're going to hold a greater amount of money. Money's going to be redistributed, and always is, continually, from minute to minute, from those areas that are losing, the demand for whose products are falling, to those areas where the demand for their products are rising. As Hayek pointed out, that's not deflation or inflation, because deflation or inflation means an increase or a fall in the money supply in a closed area. Okay, so if the U.S. is a dollar area and the number of dollars in the U.S. falls, then you have monetary deflation. Or if it rises, you have monetary inflation. Now, what's the closed area under the gold standard? It's not one country. Okay, every country's money, despite the names that they use, the differing names, every country's money is in fact gold. So the reason why, for example, Great Britain would lose gold to the U.S. under a genuine pure gold standard would be because the productivity in the U.S. is increasing faster than in Great Britain. Or let's say demand has shifted from textiles from Great Britain, world demand, to wheat. So wheat would be more valuable here in the U.S. Farmers' incomes would rise in the U.S., and that would be reflected in an increase in the amount of gold that they hold. On the other hand, those people in the British textile industries, the stockholders and workers, would find their incomes are falling. And when your incomes fall, you hold less money. Okay, it's natural. So it's just a redistribution of gold within a closed system. Countries don't have alternating bouts of deflation and inflation. In fact, that occurs when you begin to get paper money, pyramided on top of the gold standard. Then, if gold flows out, not only do you lose, let's say you lose $1 million worth of gold, but then what happens is that the banks, as they lose gold, then have to decrease their loans and decrease the amount of paper money. And what that does is to exacerbate the outflow. And Hayek pointed that out also. So it's fractional reserve banking that causes the added deflation or added inflation. It's not the gold standard itself. Under a pure gold standard, the whole world is a closed system, and as part of the world gets richer faster than other parts of the world, gold flows away from the parts that are lagging behind to those parts in which the income is increasing. The gold itself doesn't cause people to be richer or poorer, the inflow of gold. It's a result of that, okay? And it's the same thing with your household, right? If your income increases, it's because your good, whatever you're selling, has become more valuable, and therefore, what the consequence of that is that you get an increase in your money income, and you hold the larger proportion, or you hold more money income over the year than you would have. Okay. All right. What about the fifth objection to the gold standard? That it allegedly involves extremely high costs in terms of resources. Resources both that are used to mine new gold, as well as the opportunity cost of using gold not in jewelry or dentistry or in electronics, but using it as money. Okay? Adam Smith was one of the first economists to claim that the gold standard had a high resource cost. Believe it or not, the early Ludwig von Mises actually accepted this. What Adam Smith said was the following: replacing gold with paper money is like replacing a highway that goes through fertile land with a highway in the sky. Okay, so he used that analogy. Because a highway in the sky wouldn't have the opportunity cost of causing land that could have been used to grow various crops now to be used for a road. Okay, and the materials that are used in the road could also be used for other uses. So what Smith basically said was this: he was in favor of a gold standard, but he wanted a fractional reserve gold standard. He was very comfortable with that. He says, as we print more paper money and drive prices up in Great Britain, we send gold out of the country in exchange for capital goods, and that makes us more productive. So the paper money, in effect, allows us to create capital goods by pushing gold out to foreign countries in exchange for these capital goods that make our labor more productive. Okay, so that was Smith's argument. The French economists always rejected that argument, and later on von Mises did, and of course Rothbard did. There's a couple of responses to this argument. Okay, the first response is, well, even if gold standard has high resource costs, those high resource costs are justified as a way of preventing the government from inflating. If you lived in a world where, let's say, you could trust governments, right, which is a never land, not to inflate the money supply, not to do what's natural and try to increase spending and buy votes by simply printing new money. Okay, so if you lived in that kind of world, all right, well then you might say, well, we really don't need a gold standard. We don't live in that kind of a world. Okay, economists in the 19th century used to look on the gold standard as golden handcuffs. They tie the hands of government and prevent the government from printing new money. Okay, it's like saying, if we could just get rid of, let's put it this way, there's very high resource costs. There's a lot of resources tied up in steel bicycle locks. Okay. If we got rid of the steel bicycle locks and simply put a piece of paper around it and wrote lock on it, wouldn't we have all the steel to produce other things that are useful to human beings? Okay. Well, if we lived in a world where no one stole bicycles, yeah, sure. That's not the case in New Jersey. Okay. We put 2 locks on our bikes. All right. Okay. So first of all, even if there are high resource costs, okay, think of it as buying insurance against inflation. Okay. But secondly, as Roger Garrison has pointed out, we have these are economists that are making this point, and yet they're not taking into account the alternatives. Okay, remember, you have to compare institutions. What about the resource costs of paper money that causes the economy to go through a business cycle in which you have inflation and misdirection of capital that is then revealed in a recession and layoffs of workers? Okay, I would venture to say that the resource costs that we suffered from paper money business cycles that are induced by paper money, are greater than the resource costs of a gold standard. Okay, but beyond that, and actually this is Roger Garrison's point, what happened when we had stagflation in the 1970s and beyond, when we had crises in the 1980s, when we had financial crises? What do people do when they're confronted with rapid inflation or fear of bank collapses and financial collapses? Well, they rush out and they buy gold, don't they? And in fact, in the late 1970s, the price of gold shot up to around $800 an ounce. What did that do to the amount of resources in gold mining? It pushed more resources into gold mining. Okay. Why? Because people wanted to use gold as a hedge. So governments haven't gotten rid of their gold. All governments hold big stocks of gold. They haven't. I don't see governments selling that gold off, allowing the market to use that gold to produce more, products for dentistry, more electronics, and so on. Okay. In fact, the stocks of gold held now out of production may be greater than they were under the gold standard. Resources devoted to gold mining might be greater. You don't know what would happen under the gold standard. So so we can respond is, first of all, even if it is high, that is resource costs, it's a form of insurance against government inflation. Two, government fiat money inflation has caused a repetition of the business cycle, okay, to recur again and again, and that has resource costs. No monetarist has tried to add that up, okay, and compare that to the resource costs of gold. Though they have come up with figures, Friedman has and others have, of what the resource costs of gold are, but you want to compare it to something, to the alternative institution. And finally, paper money doesn't save on the resource costs of gold because people use gold as a hedge. It's the first hedge against inflation or against crisis. All right, lastly, the gold standard results in high interest rates that discourage investment and retard economic growth. Basically, this is a Keynesian criticism. Again, if you have a gold standard, especially a genuine, pure gold standard, it's impossible for the Fed to increase bank reserves and push down interest rates, bringing about a business cycle. And we know in the short run in a business cycle, you do seem to get a boom in output. And that's what they're talking about. That Alan Greenspan would not be able to manipulate interest rates. Well, I think that's a good thing. I think it's a good thing not to have overinvestment. All right. So basically, the response to that is that we don't want low interest rates if low interest rates are the result of manipulation by central banks, because low interest rates result in misallocation of resources and eventual recession. Okay. So those are my critiques of the objections to the gold standard. Let's talk about returning to the gold standard.